أصحاب السمو، أصحاب السعادة، الحضور الكريم. ظهرت بلوكتشين إثر الأزمة الاقتصادية العالمية في نهاية العقد الماضي، وقد سعى مناصروها إلى نشر الوعي بها وخاصة آثارها الإيجابية على الاقتصاد العالمي، وقد تطورت بشكل ملفت خلال السنتين الماضيتين على العديد من الأصعدة عن التطور السريع لتكنولوجيا بلوكتشين وتأثيراتها على الاقتصادات. Blockchain emerged after the global economic crisis at the end of the last decade, and its advocates sought to raise awareness about it, especially due to its positive effects on the global economy, and has developed remarkably over the last 2 years on many levels because of the rapid development of blockchain technology and its effects on economy. For discussing this topic, we invite Mr. Shivinsan Maslimani as a moderator. For the panelist, we invite for cybersecurity Mr. Khalid Rafi, for financial sector Mr. Daniel Spire, for regulatory landscape Mr. John Tierney, for real estate and assist Mr. Stefan Rend, for diamonds tokenization Mr. Emmanuel Van Bobbel.
Okay, thank you. Good morning, ladies and gents, and distinguished guests and panelists. First, thank you very much for taking the time out to be here. So, my role as a moderator is to steer some meaningful conversation between ourselves, and perhaps we can open up for questions later on. First and foremost, Daniel Spear is not here. Unfortunately, his flight's been cancelled. So, financial sector, I'll cover it myself. So I think what we should do then is do a round of introductions, just 1 minute intro, just describing what you do, your domain expertise, and maybe some description of your organization that you're representing. I'm Shivansan Maklamani, Global Banking and Market Specialist. My role is to push the boundaries in banking sector and help with developing new business models and engaging the key decision makers in banking and markets. My background is 20 years. I started out in investment banking capital markets. I then evolved into, following the credit crisis, to restructure global tier 1 banks. So I spent the last 12 years restructuring banks, which is primarily driving change. So I'll start with you, and then we can just pass it along from our right.
Thank you. Yes, it's a big pleasure to be invited to Oman, a country which I have been a couple of times before and I like very much. Stefan Rindt, originally from the banking industry. I started a real estate company back in 2002, Colonial Real Estate, which became the 3rd largest listed real estate company in Germany. And we then sold the company in 2012. Since then, I'm business angel, investor, entrepreneur in many companies. And about a year ago, I ran into blockchain technology and was really fascinated about it. So we started a project called Brickmark, Brick for stones and Mark for Deutschmark. And the idea is to bring real estate onto the blockchain. And we are creating a product in this area, and I will tell you more about it later in the conversation. Thank you.
Okay, thank you.
Hello, so my name is Khalid Rafi. I'm acting CTO of a company called Arca Trust. We are a bunch of cybersecurity experts who work on blockchain technology and take care of ensuring that whatever is being developed and deployed as a solution is done in a very secure way. We've been doing this for almost a year now. My own background is in cybersecurity and cryptography, where I've been doing partly an academic career in top European universities, and then moved to build highly secure payment networks nationwide in Switzerland and in Europe. And then now we are applying this knowledge and all these things that we gathered over the years, over the last 15 years, to the blockchain world and to these new infrastructures that are coming up now. Thank you.
Good morning. My name's John Tierney. I'm responsible for global sales at CoinFirm. My background is similar to other gentlemen here, is capital markets and investment banking for the last 20, 30 years. Started off as a financial futures trader in the City of London, before moving into selling enterprise-wide front, middle, back office trading systems globally. More recently moved into selling the software for architecture and process management, and I've only recently joined CoinFirm probably about 2 months ago. So it's the blockchain and the cryptocurrency is very, very new to me, but very exciting. So I'm hopefully being able to do the transition from the old world into the new world. CoinFirm itself has been going approximately 2.5 years. The technology was sort of hit the market probably about 18 months ago, and the growth has been very, very rapid. We offer KYC and AML services to crypto wallets, addresses and tokens. So we can do full KYC check and AML ongoing monitoring checks on the wallets that get transacted on exchanges, within banks, etc. So very much looking forward to the next few days. Thank you.
Hi, good morning. I'm Emmanuel. My background is from the diamond industry. I'm based in Antwerp. I've been working as a diamond trader for over 20 years for the beer site holder in Antwerp. In 2015, we have founded the MDAX Brinks, which is an online exchange for the diamond industry. And in 2016, we founded a new company who's going to use blockchain technology to do basically diamond securitizations.
Hi, my name is Justin. I've been working with and around cryptocurrency for about 5 years. The latest project that my team did before I joined Swisscom Blockchain was the X Wallet. It's an interface for Monero, the cryptocurrency Monero, because one of the things that we saw with Bitcoin was it's lacking in privacy. So Bitcoin is totally transparent and completely traceable. So if we move to digital money, people probably want to continue using cash, right? There's certain benefits with paper cash that we get, including privacy, and we want to figure out a way to carry that over to the digital world. But at Swisscom Blockchain, I'm one of the solution architects. So I'm currently working on a product called the SBX. This is the Swisscom Blockchain Exchange, and it's a totally peer-to-peer cryptocurrency trading system.
Okay, thank you. So just to kick off, I think I will start with the financial sector in the absence of Daniel Spear, and obviously I can cover it. Blockchain means a huge deal for financial sector and banking in specifically. Fundamentally, we're looking at how banks operate and what's the key role of a bank from here on. And there are extremely large challenges ahead of us, mainly infrastructure, regulation, legal framework. But I think we are pushing the boundaries also in the digital transformation to change how banks operate. The first thing is to address that from the inside of the bank, change the culture of the bank, and that's changing the people, the systems and processes. And this will happen in time, but however, we have to make sure that the the role of the bank is addressed in a manner that it continued to operate as a service provider, but the heart of the operation is customer focus. So going back to the challenges, the regulation is a huge piece, right? So over to you, John. You guys specialize in compliance, specifically anti-money laundering, right? So this is a big topic, whether it's traditional finance or the new world, cryptocurrencies. How is CoinFirm positioned to address this from a technological perspective?
So I can sort of give you my experience so far. So I pretty much, like I say, started two months ago, and most of our new opportunities are either with existing, a lot of Swiss banks, surprisingly enough, and new banks coming to the market. And just going back to where I used to work in the investment banking world, mainly in the City of London, as Shabin said, there's such a lot of ingrained technology that is so old. To actually re-engineer the whole thing is a massive task. Whereas with the new banks that are coming to the market, they have the ability to not only cater for the traditional fiat world, but with the new technology, including ours, you are also able to accept the crypto. So you're moving to two new business streams. I think, again, in my experience, that the struggle that the bigger banks have is that there is business as usual. Just the cost of actually keeping the lights on day to day, especially in London, and the huge regulatory changes that's happened over the last 2 to 5 years has meant that any kind of budget that would be deemed for technology and development and intervention and integration and stuff has been put on regulation. So I think that world is slowing down slightly. But from a regulatory point of view, we work a lot with global regulators in trying to accommodate the crypto side. So you put a normal framework that you would do for fiat, for AML as well. But there's definitely nuances in and around the crypto space which are quite obvious. But hopefully, with working with the various regulators around the world, we're trying to build a standardisation. It's very tough to do that. And I was on a panel only last week in London where I think the overriding sort of acknowledgement was without the regulators accepting sort of blockchain, crypto, etc., the actual adoption within banks and other organisations can be very tough. So regulators play a very, very key part in how this sort of technology can move forward in the financial world at least.
So presumably then there is a regulatory consultation that's going on because to have a standard set of rules, you need to harmonise a bunch of regulators, and then you also need to bring all the key actors into that. Are you working with some sort of a consortium, or are you talking to each individual regulator with your interests, or is there already a common set of interests?
So again, it depends on the geography. There's certain geographies globally that are much more adoptive of crypto and blockchain. I'm doing a lot of stuff in a place called Gibraltar, which is a very small financial hub in sort of southern Europe. Japan has been a big adoption of the crypto world, so their regulators are, probably more forward-thinking than a lot of the sort of European regulators. The Swiss regulators, I'm starting to work with a lot of Swiss companies, they're very, very forward-thinking, but it's pockets, and I think that's the problem at the moment is there's not always the desire on a wider scale for adoption. It's very forward-thinking countries and regions that want to attract new technology, and I think the Middle East could be one of those. It's a very young sort of financial sector, and you guys have the ability now to sort of grasp and learn by the mistakes of, say, the UK, that's very sort of antiquated and it's very staid in its ways, and the US to a less, maybe even more degree. I think the banking sector will change significantly over the next 5-10 years, but you do need that regulatory control around it.
Yeah, that's really true. I think in the West we have a huge appetite for this technology, and then we are facing the challenges on a day-to-day basis. And drawing from our experience in investment banking and capital markets, one of the problems that we've had, or we still continue to have, is the lack of ethical practices, right? So that's something also that needs to be addressed as part of the compliance. The other side of the coin of this is security. So I'll bounce this back to you, over to you, Khalid. What does security and operating in a secure environment means, having this powerful technology which can open up so many doors, but we also have to think about privacy, security, and a secure environment where we can harness these things?
Yeah, so actually, if you look at it in the old world, we used to have papers that we store in bunkers and in secure places and have soldiers guard it. Now we're kind of digitalizing everything, right? Blockchain is kind of the real digitalization and tokenization of the assets. And for these assets that we're now storing in computers, we need to equally ensure that their content stays safe, that nobody who doesn't have access to can access it, right? In the old world, you can, if you get a paper, right, and you run with it, then you can see that it's not here anymore. And you have to be physically in the building, physically enter it. With the digital world now, you can have someone sitting on the other side of the world on his computer and dumping all your data, getting all information about you, public, secret, confidential, classified, without even you noticing. Or you may notice after a few years. Just if you look at several hacks that happened over the last month, the Yahoo one, for instance, 53 million passwords stolen. They were realized 2 years after, right? Who knows what they did in between? So this is where actually we came in and said, we know how to build secure system. We've been doing that for highly sensitive industries. We've been building payment networks, interbank clearing systems nationwide. And then we apply this very same knowledge, which from a pure technical point of view is not that different. It's just that the stakes are now much bigger because we're putting all our data online. We're putting our lives there. So we need to ensure that this is done properly, this is done in a very secure way so that you can move forward with it.
Agree. We already have these things, right? So we've got all our information online and served in some server somewhere, but the lack of openness now, that we have so much openness and we're storing everything digitally. So what about redundancies? How do we make sure if the digital space vanishes, how do we then recover from that? Say, for instance, I have this right now, right? If I lose this iPad, it switches off. I've lost what I've got here, the information, right? So are there enough redundancies that you're building so that in the absence of the paper, there are ways that we can actually get our data back securely?
Well, actually, resiliency is part of the design of any system that you have to put in. You have to take into account of data duplication, for instance. Having your data in multiple data centers or multiple computers that you still control, right? You would have, let's say, one data center here in Muscat, another one in Salalah, for instance, so that if anything happens in here, you will have a second site on which you can get your data back. And then this is a process you can replicate to any number you would want for higher resiliency there. So you could have it over 3, 4, 5 multiple sites and run it this way.
So you need to have the physical redundancy, the systems redundancy, and also processes, right?
Sure. I mean, the physical redundancy is is bound to the fact that in the end, it's still a computer and it's still a hard drive and it's still data that has to be put somewhere, right? So this redundancy, although it's digitalized, the data itself, but the infrastructure and the platform it's running on has to be taken care of and redundant. Sure.
Okay, thank you. Now, let's talk about the actual potential of the technology and how it can actually change the business as we know it. So I think real estate is a huge topic when it comes to tokenization and the ability to break up the investment portfolios and to be able to do fractional ownership. And I think there's a huge value prop to relieve the capital trapped in the real estate investments. So, Stefan, if you can just give us an overview of what all this means to the real estate and the assets, and how tokenization could possibly, having the right regulation and the legal framework, can change the whole game of how we invest and how we own property.
Yeah, I mean, if you look at the global wealth, the biggest store of wealth is real estate. About $220 trillion in the world is in real estate. About 1/3 of this is not investable, but 2/3 are buildings and complexes, and only 5% of this is publicly accessible right now. So it's rather traded as a public in a public real estate company in shares or in fund units, but the rest is in private hands. On the other hand, if you look at investors in cryptocurrencies, we had about 50 million wallet owners about 12 months ago. So people who can buy cryptocurrencies in a digital way. This year it's supposed to be 250 million. And next year, probably 1 billion. So we talk about 1 billion investors on a worldwide scale in about 12 to 24 months. So the idea now is to unlock these values and create products based on blockchain, cryptocurrencies, where people can invest from anywhere, anytime, in different real estate projects in the world where they usually has no access to. So I think that's a great potential of real estate. And it also increases the transparency of the market, which in many markets is not given at this point in time. So this is also, I think, a big benefit.
Okay, but for any asset class to be useful, we need a marketplace, an organized marketplace, and the byproduct of that is liquidity. How do you see that happening for real estate tokens?
Well, if you look at the trading volumes of cryptocurrency over the last 5 to 6 years, so we already reached about 200 billion market cap of all cryptocurrencies as of today. And the biggest trend I see right now, which also brings institutional money into the market, will be asset-backed cryptocurrencies, so security tokens. Crypto coins which are backed by real assets, whether it's real estate, gold, diamonds, or other business models. So that, of course, requires regulated exchanges, which we don't have so far. But big players in the market like Intercontinental Exchange, the owner company of the New York Stock Exchange, SIX, the Swiss Stock Exchange, there are many players in the world which have already announced big projects to have regulated cryptocurrencies being traded. So I'm pretty sure that over the next 6 to 12 months, we will see the first marketplaces. There's also discussions about ETFs and other products based on cryptocurrencies. And I think that once regulations is there and there's a regulated market environment, then institutional investors, pension funds, insurance companies are able to invest in this sector. And then the amount of money which has been invested into cryptocurrencies so far has only been the tip of the iceberg. Then we talk about real money.
But realistically, that's sometimes in the future, because there's a lot of stuff that needs to happen, like infrastructure, regulations, and legal aspects need to be sorted out. But do you see an OTC market emerging? Because if you really think about the potential to take REITs, for example, right? You can break that up and tokenize it, and then you can have a private blockchain, and then you can do an OTC. So do you see OTC will be the first point of call? And then from there, we can then start developing these much more regulated exchanges.
Well, actually, I see that the regulated market will be the breakthrough first. I see that whenever you create a product for investors, whether it's real estate or other asset-backed, then it takes regulations to set the set of rules. And one of the, if you look at the price developments of the cryptocurrencies over the last 6 to 9 months, they were going down. And in many cases, there were a lack of rules and lack of regulations in the market why this happens. So I think we'll see first regulated products out there. And actually, you know, if you look at security tokens, security is already part of this. So, you know, take Brickmark for an example. We take a perpetual bond, so a regular security, which we get fully prospectus in the EU zone as a basis for the token. So if you take a normal security, which are out there, whether it's a stock or a bond or a hybrid product, and then tokenize it, you just do a classical, well-known product already and just digitalize it. So then I think if you listen to the last comments by the SEC or other regulators, they just want that these kind of products are going to be regulated as a normal security. And if people start, like us and others, you know, to follow that rules and create a security just based on a token with all the benefits of the blockchain, then I think it will be rather sooner adoption in the market than later.
I agree. We already have rules for all these asset classes, but just by transforming this into the digital asset space, I think there is a little bit of disconnect between the securities rules currently exist and the enforceability of those rules of how we trade, exchange, and settle these securities. Okay, so just to go on to the other side of the spectrum, over to you, Emmanuel. This is very interesting. Diamonds.
Yeah.
These are not usually deemed as investable commodities. However, we all know that diamonds have its value and how that value is a closed world where the price is determined. What does blockchain means to diamond industry, and how do you see the changes playing out there?
Yeah, that's a lot of questions.
Yeah, I know.
So first of all, the diamond industry is very opaque. And what people know from the diamond industry is most of the time the end product, the jewelry or the auctions. To answer your question regarding investments, diamonds are used as an investment to hedge real-world inflation. We're not correlated to any other commodity or the US dollar. And if you take, for example, the auctions, a few weeks ago, a 19-carat fancy vivid pink was sold for $50 million and bought by Harry Winston. Harry Winston, a very famous jeweler, just to give you an idea that they are used as a hedge. Lawrence Graff bought 3 times his own stone through the auction from Christie's. He bought it in 2005, I think for $4.2 million stone, and then bought it back, his own stone, at $8.3 million, just to give you an idea. Blockchain is basically, our industry was one of the first and early adopters of blockchain. And basically, what you said is our industry, the diamond industry, being very opaque, and then you have blockchain on the other hand, which is very transparent. And then the question, of course, arises, how come that we as an industry jumped on it very early? And the reason of that is because we could solve a real-world problem using blockchain. And one of the real-world problems is consumer confidence. As we see today, the clients, and especially the millennials, are more aware and they really want to know the provenance of the product. Now, blockchain has basically the characteristic to create immutable ledgers, and we can then basically trace it back for provenance. With us, Siliqua, we use blockchain to tokenize diamonds, basically to give fractional ownership of one particular stone. So I started off by telling that diamonds as an investment today are used through auctions, but that's only for a handful of people. So if you really want to open up that market, you need a few things. You need transparency, which is not really there in our industry. You need a marketplace, and you need to give access to a broad audience. If you see how people are investing in diamonds today, there basically are three ways. Either you go through auctions, Sotheby's, Christie's, Bonheim's, where you pay 12 to 25% commission as a buyer, plus the local VAT. Or you can buy at a high-end jeweler, Van Cleef & Arpels, Cartier, Harry Winston, or you can buy them online, like Blue Nile or James Allen. So in all these three categories, you're not really investing in diamonds, according to me. You're just buying a product. And once you have the product, you still have all the hassle of paying the VAT, storing the diamonds. So for example, if you take the third example, you're going to buy 1,000 stones online because you think you're tech savvy, and you're going to outsmart the market. Where are you going to store them? You don't want to have them shipped at home, right? But the real problem is, if you want to sell them, where are you going to sell them? So in the three categories, only the people who can invest in very rare stones, the vivid blues, the vivid pinks, they will have the potential to make a return, condition they can sit on it for a while. Another problem is it's not liquid, meaning you can't really chop off or chop it in two or in half and say, I need half of the worth of my diamond. It's not a fungible asset, whereas gold, you chop it in half and basically you have the same value. If you do that with diamonds, it's not really the best idea.
Yeah.
So we use blockchain to tokenize diamonds, to give fractional ownership to the market, create a market, and using blockchain, the byproduct or the kicker is transparency.
Okay, so the challenges of divisibility, a common marketplace, and transparency. What about pricing? Because I've had a conversation with you some weeks ago, and then you were able to explain to us how the pricing works, and I was pretty shocked to hear how it works, because it's a closed industry, as you've mentioned. Isn't that a huge problem also, pricing of actually raw diamonds? I'm not talking about the diamonds in a product, I'm talking about the diamond itself. How does the pricing currently work, and how do you see that changing into a much more of an open mechanism where we can have usual market forces to determine the price of diamond? Well,
You got two different worlds in our industry. You got the rough world and the polished world. And basically, we're so old-fashioned. In the office itself, you will split up one department rough and one department polished, because you don't really want one part to know what the other part is doing. That's basically how far we go. So rough pricing is more of an art where you basically get your set price from either the bureaus or our ROSA. It goes through, you get the boxes every 5 weeks, and basically you pay up front, then you get a box, then you can open it, and then you send it to the factory. By moving rough diamonds from left to right, up or down, you will make or lose money. That's why, for example, Antwerp is still the 80% of all the rough passes Antwerp. Not because we have diamonds, of course, in the ground, but we have the expertise to basically know what kind of rough we're going to send to which factory to have the maximum output. So that's a completely different story. Once it's polished, it's kind of more commoditized in the sense that we all have the colors, clarities, where basically they determine the price. And then we follow a list. We follow a list which is published every Friday by Mr. Martin Rappaport, and he's an individual, and he basically determines the price of the diamond on all categories. Now, the thing is, there's nobody else who is doing it, and we work on discounts. So every Friday, the price of 30 pointers or 4 grainers or 8 grainers can go up or down based on who knows what algorithm. He's not going to share it, he doesn't want to share it, but he was very open about it. He said, nobody has to follow me. I'm not forcing anybody to follow my list. But we are so used to it, to think in discounts. If you ask any diamond trader in the world, I just bought, I don't know, an 8-grainer FEVS XXX non-fluorescence. Nobody will tell it, no diamond trader can say, oh, it's like $8,425 per carat. He will say, I can buy it at 34 back. I can buy it at 35 back. So we calculate with our stomach on discounts. And that's basically why we all follow the list, because it's recognized and used everywhere. Yeah, that's basically the pricing mechanism as we have. So we have the rough, which is more of an art, and then you have the polished side. At Swiss Derivatives, we had once a discussion and talking about commoditization of the diamond industry. It is not that much the diamond itself that can be commoditized, according to me, is the certificates. So every diamond today, 30 points up, will carry a certificate. And based on that certificate, we will determine the price.
And that's quite interesting. So, apart from the liquidity reasoning, I mean, currently the commodity is just not liquid, it's quite illiquid. And this is going to bring a huge amount of liquidity, right? But again, we're back to the same old problem. We need a marketplace, and we need regulations. So where is the current set of regulations which govern how the business is done in the diamond industry now? And then how do you see that either changing, or do you see there will be a new set of rules that need to come in just to cover the tokenized or asset-backed securities, the underlying asset being diamond?
Yeah, I think there are two things here. First of all, the diamond industry as such is not a regulated industry. But where we want to go with the tokenization of diamonds is basically the same as Stefan already mentioned. Sliqua will go for full female license, where we have a securities broker-dealer license. Because at the end of the day, when we're going to give fractional ownership of diamonds or tokenize a one-on-one diamond, it's a security. And we are then bound by how fast FINMA is going to issue new rules and regulations.
Okay, so John, I'll bounce this back to you, because this now concerns compliance for tokenized securities. I know you guys currently cover cryptocurrencies compliance, AML, but how about tokenized securities? How do you see that playing out?
So I was just going to jump in actually with Stefan. I'm actually working with a new exchange that's coming to Gibraltar. It's going for its license now, doing exactly real estate. So they've got Chinese backers, potential Chinese investors. They're offering a coin, token, and it will be to buy high-end properties in London. So it needs different tweaks to the regulation, so that they're going for the DLT thing. In Gibraltar at the moment, they're probably one of the most forward-thinking sort of jurisdictions and regulators probably in the world when it comes to DLT and stuff like that. So it's a work in progress. They've gone through their first round. They've got another round of questions come back saying you need to be, stricter on these particular areas. But it is happening, and so our software is able to do, in theory, like a stablecoin kind of effect, where we can actually still, doesn't really matter about the actual token itself, we're sort of agnostic. So the software is able to do stable coins, do these tokenizations as well. So we don't really see it as a problem, it's more the regulatory side. And just on the point of the regulator, I sit with the regulator quite a bit, and it's not necessarily the results that we can give back to them. It's what the processes are in that organisation once a high risk is triggered, for argument's sake. It's the processes following that they're more concerned of. It's more the sort of whether the bank, the organisation has the right policies and procedures in place to action something if something goes wrong. Because they're seeing a lot of maybe ignorance where a high risk trigger has been triggered and they've just sat on it and not done anything, and about 3-6 months later it's come and bitten them. So what I'm learning from the regulator is there's tools out there that can give the indication it's a high risk or something's wrong. It's what that company does with it afterwards. That's the most important thing to them. But it also depends on the regulator whether they're even willing to even look at crypto and stuff, and it depends on the region again. So there is no one rule, unfortunately.
Sure. Do you think stablecoin is setting the direction to going into a cashless society, or somewhat changing the way we transact, whether we are using cryptocurrencies or fiat? Now, also stablecoins is bridging the gap between how the value can flow between the cryptos and the fiat world. So do you think regulators should start looking at how to deal with and perhaps, to a sense, regulate the stablecoins itself, which will be the right place to do the regulations, and then from there, using that as a stepping stone, we can go into the rest of the asset classes, and then that way, you know, the source of the problem is addressed, which is to bring much more integrity into the asset classes, cash being the king of that.
So again, in my limited experience, we have a very large customer in the Far East that has just, or in the process of launching their own coin. It's probably one of the top banks in the world. And we are doing the underlying technology for that particular coin in Japan. And the reasoning behind it was they wanted to be a first adopter. They have their own coin now. But it was to retain client base, but also offer their clients another option of payment and a more efficient, cost-effective way of payment. So it's going to be a very, very gradual rollout, very gradual adoption, where they can just literally tap their credit card on designated restaurants, bars, taxis in Tokyo, and they have the option to pay in fiat and or in crypto. So I think from a regulatory point of view, from what I understand from the team, is that it's been a hand-holding sort of experience for the bank, the regulators and us, where we've all sort of had to look at all the different areas of concern that the regulator has, but then work through it together. And I think, again, going back to a panel that I was on last week, I think that's the only way these things are actually going to work, is if you have a 2-3-way conversation with regulators, the banks, the government even, on how best to do it. Because you're right, because stablecoins in theory should take away the volatility and the fear of doing it, and it's just the underlying technology that you're using. So whether it's called stablecoin in the future, I don't know, but that mechanism is, I would see it as the way forward for our new world, if that makes sense.
Yeah, it's a good starting place, right? I mean, if you look at speaking from the financial sector myself, we have something called the USC, stands for Utility Settlement Coin. So this is a experiment between UBS, Credit Suisse, and Clearmatics to remove the cash leg out of the interbank settlement process. So what interbank settlement is all about is banks pushing cash between themselves. What if we tokenize that? That is stabilizing that process, and thereby removing the cash out of there, you could streamline that process, and it's fast, cheaper, and the rest of it. Talking about that, Justin, atomic swaps, is this just an alternative to having an exchange, or is this fundamentally important to safeguard and improve the liquidity and marketability and tradability of cryptocurrencies within the crypto space, not fiat?
That's a good question.
Thank you.
So probably the first thing I would do is clarify what is an atomic swap. because we use a lot of buzzwords. Not everybody knows what the buzzwords mean. So the idea of an atomic swap is if you put it in terms of today's cash currencies, if you could imagine that you have like a cash euro and a cash real, and or I guess if you live here in Oman and you want to buy some cash euros, how would you do that, right? You need to find someone that has that physical cash. So normally we go to an exchange at the airport, or there's a cash exchanger person. Maybe they sell top-up minutes and this sort of thing. And then we can exchange the cash in person. And we always do it in person to avoid being cheated, right? That probably goes without saying. The idea is that if you were to go online and go to an internet forum and just randomly find a person that agrees to send you euros if you send them your cash real in the mail in an envelope with postage on it, the first person to send their cash is the sucker, right? Obviously you wouldn't expect the stranger on the internet to honor their side of the trade. And so I think since the internet started and e-commerce became a thing, people have had trouble just making payments on the internet. Even today, the only widely accepted way to pay, or sort of expectation that you would have to pay, is with a credit card or a debit card. And this is tricky, right? Because not everybody has a credit card or debit card. And there are often problems with these things, right? Fraud is a huge problem with these things. Do you guys know all of the problems already with these sorts of payments? And so really the magic of cryptocurrency is that it solves some of these real world problems. So basically, when you use cryptocurrency, you can pay for things online like you would be actually putting physical cash in an envelope and mailing it to the merchant. And this is totally unique, because with cryptocurrency, you could do that and you're guaranteed that the money gets to the merchant, and you're guaranteed to get a receipt. And there are other properties that you have with this as well, right? You don't need to have a bank account. You don't need to ask anyone for permission to make this payment. It's a very sort of powerful tool that we have. Now, let me get back to the atomic swap thing. So, as I'm kind of circling around, so the idea of an atomic swap is that you can actually do this cash exchange in the mail, but you're guaranteed to get the deal done, or the deal doesn't happen at all. So the word atomic comes from atomicity. It's a property that we have in databases. So one property that you want in a database, now here's this word transaction, but we talk about transactions in a database as well. So in a database transaction, you want the database to be updated the way you expect it to be, or not at all. Right? So that idea of atomicity is where this word atomic comes from. So this is a really cool thing that we can do. It's an algorithm, right? So there is a ceremony that we go through with the other person to ensure that we won't be cheated. And as long as we follow that ceremony and we use these cryptocurrencies and we follow the rules, then we're guaranteed a positive outcome for this trade. So what we're building now is actually a tool. So it's actually just software that you install on your computer, and it allows you to do these swaps between different cryptocurrencies. And this is really interesting, I think, because these guys were talking about tokens and talking about, central bank digital currencies, and maybe there is some sort of central bank that issues a cryptocurrency of its own. And this cryptocurrency could even be backed by something. It could be backed by Bitcoin, for example. This would be actually unique in the world to have a central bank that issues a fiat currency that is pegged to something, right? Most countries went off the gold standard sometime in the 1970s. This would be sort of an opportunity to go back to this era of responsibility. So if a government were to do that, then you would be able to continue using a local currency or even a regional currency, And then you would be able to swap these local and regional currencies very, very easily and provably and almost instantly using this swap method. So what this really is it's a building block, it's a foundational technology that we can use today, and we're really setting the stage for what's to come over the next 10 years. And we're a little early with this, but maybe not too early.
Based on what you've just said, the last word, we're early, and the word rapid development, so there's a gap there, right? So we've got the technology, the technical feasibility is there, but our understanding and our ability to master it and to really grab hold of the use cases and making that happen, that's a different thing. That's practicalities, right? But then again, when we look at the difficulties with the payment as we know it, the main thing is chargebacks, and immutability just kills that, right? So do you think this sets somewhat a standard where later in the stages when we tokenize, whether it's a real asset or diamond or a classic car, that approach will be really useful because we don't have to go into fiat. We can operate within the whole crypto space with the safe and security of the fiat world as we know it, right?
Yeah, so the whole idea is that this means that you don't require any third parties to help you, right? So you see this even with banks today, right? You have this idea of correspondent banking where banks have accounts at other banks, and this leads to some complexity, right? And yeah, I think that's really where it's going. Is it's going to a world where people are going to be able to be autonomous and independent, and they're not going to be so dependent on third parties to help them do things like complete their transactions. In terms of buying things online, I don't think people are going to need banks if they don't want to use banks. All you need is a laptop and an internet connection. And I mean, you can really go totally sovereign, and you can install an antenna dish and a radio, and you can still use Bitcoin, right? You could be totally off-grid. So the technology that we have is there, and really it's just from what I've seen, it's a matter of education and timing, right? So you can even see it in the markets. I think people aren't used to seeing a truly free market. When you have a truly free market, what happens is people, I think, are naturally a little bit more tribal, right? We like to stay in smaller groups. So I think the number is 150 or 160. And then outside of that small group, or if we're all in a room together, then we can work together easily. But as we expand outside of that group, naturally we don't work as well together. So this technology allows us to overcome that. It's something that's really interesting that we have, and I really do think that that's the direction most people will go, is you will operate in your groups, and you will have the opportunity to invest in some of these other assets that people are producing, other groups are producing, and you'll be able to do so in a way that does not involve the requirement of a custodian, if you don't want it. I think some people probably still will use banks. I think people still will delegate a lot of responsibilities to others, but that requirement, I don't think will be there. I think the way that we look at trust, and we trust our business partners and we trust each other, we'll be able to return to something much more organic. I think today it's pretty strained.
Okay, just very quickly I'll add to that. I share that thought with you from a banking perspective. Banks will not be doing the financial engineering, technology will. Banks will become a place where the customer relationships will live and be nurtured, and that, I think, will be the primary role of a bank, whereas now the banks actually do financial engineering and do sales. So it will be more customer-centric rather than sales-oriented. That's all we have time for. So thank you very much for each and every one of you to take the time out and to do this. So we will then just go into the break session, I believe, next. Thank you.